The S&P 500 started the year on the back foot, but as always has started its road to recovery this week. What is the prediction for this index for this year during an economy experiencing tighter financial conditions? My name is Connor, the Senior Market Analyst at the global brokerage firm Zenfinex. I provide forecasts on various different markets on this channel on most trading days, and if you enjoy them, make sure you hit that thumbs up and subscribe to our ever-growing channel. Today's video is going to cover an S&P 500 forecast for 2022. Enjoy. Okay, so let's get straight into it, and if you've watched my previous videos on this channel, you know I like to monitor what is happening with monetary policy in the US. And yes, I will be mentioning inflation again, and we're at a stage now where we all know what the Federal Reserve is planning to do, right? They want to tighten financial conditions by tapering its bond purchases. This is really no secret to the market, no secret to us as traders. And if the market was to negatively react from this, in a way that would mean the S&P 500 finishes down this year, we'll be seeing clear signs of it by now, and this has negatively affected the S&P 500 over, say, the last couple of weeks. But this is just another buy the dip opportunity, which we're going to see on the chart coming up in a few minutes. So the way I see it is really we have two scenarios, is what I like to call it. So the Federal Reserve scenario one is the Federal Reserve start to taper in March, which is, in my opinion, 70% priced in already, and it means the S&P I don't think shrinks as a result, but maybe just grows at a slightly slower rate. Albeit we have already seen the drop in price of the S&P 500 from the expectations of an earlier taper. The alternative is that the Federal Reserve need to kind of reverse their policy or slow down the tapering process somewhat, and this creates an environment which indices like the S&P 500 and the Nasdaq 100 thrive off, i.e. looser financial conditions, lower interest rates. Now, can we expect a similar performance to what we saw in 2021? Well, not really, in my opinion. It's unlikely. The market grew 27% in 2021, and this was driven by low interest rates and massive amounts of government stimulus. Now, unless the financial conditions in the economy become tight, which they won't, just tighter than what we've seen, what we've seen is record-breaking borrowing figures that we've seen previously. I find it very difficult to see how the S&P 500 finishes down this year. In fact, I believe we could be heading towards that 5,500 mark. Now, of course, you can monitor the earnings, the sales and the profit margins for the biggest firms in the index to give you more of an in-depth, detailed analysis. And this includes obviously like your Apples, Microsofts, Amazons, etc., Google. And you'll find that the outlooks are still bright for these big giants, and most of the market gains are down to these big five firms. And with that being said, I do think there is a case for a shift from growth to value stocks, but as a rule of thumb, you just don't bet against Wall Street in the long term. And with that being said, let's take a look at the chart and mark those key levels to watch out for. Okay then, so I'm on the chart for this S&P 500 index. Now, I think first of all it's clear what sort of trend we're trading with at the moment, and why I said at the end of that last slide not to bet against Wall Street, or why the general saying is not to bet against Wall Street. That's because every single buy the dip opportunity that we see is greeted with buying power, with buy the dip traders. Obviously we've got this massive dip from the pandemic, which is fair enough, but even when we go back all the way back at like 2017, you can see that the market is just trending in the upward momentum. You can see that anyone who's really likes to trade sort of trend lines, then we have a quite clear trend coming on. Hi guys, thank you for listening to this video. Just really quickly wanted to touch on a really exciting offer we have on the website. It's a limited time offer, and if you head over to zenfinex.co.uk, you will see the offer in front of you straight away. And this is that you can trade Forex on a standard account with raw spread plus zero commission. And now Zenfinex is also an FCA and no dealing desk execution broker. If you are interested in this offer, you can get in touch with the team by clicking learn more, or you can simply go to open an account where you can start the application process. And this quite clear ascending channel Sorry for the poorly drawn line there. If we go from the bottom, and as you can see, really, if we're using this one back from October, it's like the extreme of this trend line. I'm not really a trend line trader myself, but you can see how well it is respected, to be fair. And if I now just add on kind of the main moving averages that I like to look at, you can see even clearer why this market just can't go down really in the long run, or it seems that way at the moment. If I zoom right into the current price action, I'll get rid of these trend lines because I think we can see the trend quite clearly. From this recent dip that we had, this kind of risk-off mood that we had coming into the new year, potentially a situation where the market was pricing in maybe an earlier interest rate hike, and obviously inflation tends to be sort of bad news for stocks. Is the general feeling. But what you can see is, just like we saw in November, just like we saw in December, and we saw it again in the middle of January, is when this market has rallied down and tested any of the big moving averages, like for example the 100-day moving average. I mean, that was just a great buying opportunity, and congratulations if you got in on that one. You could have had your stop loss just sitting below that 100-day moving average and bought up. But again, you could play the market from the 50-day moving average as acted just as well as a support level as any other. As you can see, yeah, we did get a close below this 50-day moving average back in the start of the week, but it wasn't very confident. It wasn't a confident close. I wasn't sure on it. We were just flirting around it. But as you can see, the very next day, the candle snapped right above, and as you can see, I think we're really looking to go and test all-time highs again, in my opinion. So with that being said, you can see just some price inefficiency that we have in here, which I think the market is going to feel in the next couple of trading days, maybe next week. But my target for 2022 is, for me, up at around this 5,500 level. Seems quite far away at the moment, doesn't it? But if I actually mark that as our 2022 take profit level, that's where I see the market going. And the way I'm going to play this is I'm going to be waiting for kind of the market to... So what we could do is, if we wanted to place a trade right now, if you wanted to be slightly more aggressive in your entry, and of course we want to be holding this for a fairly long time, you could look for the to create a new high up at around 4,880 with a stop loss just sitting below the 50-day moving average, which is around a 2.5 risk reward trade. Pretty simple stuff, really. Or what we want to do maybe is go into a lower time frame and wait for that clear break of structure that we have, which we can't really see at the moment. Maybe we could get in from, you see some price inefficiency here, maybe we're going to come and test this hourly order block here, and then we can look to buy and maybe test the all-time highs up at around that 4,819 mark. But I think whatever your trading style is, whatever your trading entries are, for me, my take profits are going to be, first of all, up at around these all-time highs. First of all, is target number one for the next, maybe, I don't know, couple of weeks, maybe a month or so. Of course, we're going to get some more buy the dip opportunities in 2022. You can see that the market, even in 2021, when we had that massive gains based off low interest rates, we still had these dips that we could actually look to buy from. I think we'll get the same situation here. Let's say that we let this market run up and create a new high, maybe at around 4,900, testing 5,000. Let's wait for the next dip below there, and then it'll be a case of jumping into the market. So really simple plays with the S&P, and that's why people love to trade it. People actually claim that this sort of trend is actually potentially rigged in the market, which is another story. But as a whole, targeting that 5,500 level for 2022, and I don't see the market breaking any structure below 4,500 for this year. So that's it for S&P today. If you've enjoyed this video, make sure you've given it a thumbs up. Make sure you've subscribed to our channel as well. It does help boost our channel, and we appreciate all the support that the channel is getting, and we do have some more big things planned. Other than that, I hope everyone has a great trading day, and I'll catch you all for the next video. Cheers.